Good afternoon, traders. It's Bill Baruch with Blue Line Futures, and this is what's moving. This morning started off with retail sales, a hot number. May month over month was much better than April. But you know what? Year over year, it still was down 6%. We're seeing the economy start to bounce back a little bit from the zero demand lockdown conditions over March and April. And, maybe some of that in early part of May. But this isn't the first number. We started to see it yesterday in New York Empire State Manufacturing. We saw it last week with Michigan consumer data, and before that with the better jobs. I said it, a better job situation than expected. So we're starting to see the better data. Is this a dead cat bounce in growth, snapping back from, again, those lockdown conditions, or is this something that's going to continue? We tend to believe we're going to start to see some stagnation after this month, and we have to work through the summer. But where it will pick up is the end of quarter three, and that's going to set the tone for the really quarter four. And that's one of the reasons why we do like the U.S. dollar. And that leads into Fed Chair Powell today. Fed Chair Powell, he did say that the Fed will unwind or begin to pull back some of the measures as the economy upticks. And we think that's very appropriate. So we did see a little bit of volatility in the market as Fed Chair Powell was talking. He sort of reiterated the same tone that he had last week, and there's going to be a long road ahead. He's preparing the economy for what is to be, but he's also justifying the kitchen sink after measure that's been done in devaluing the dollar, devaluing the U.S. currency. But he is justifying that by continuing to say the long road ahead. And yeah, given there is a tremendous amount of uncertainty ahead, and you know what, despite that uncertainty, the stock market likes it. There is that Fed liquidity, that balance sheet that's well over $7 trillion now. So today, despite a little bit of volatility, we were much higher to start the day, approaching that Wednesday's close gap, 31.75 level. Thinking Wednesday and Thursday and Friday sort of bled together. A lot of overnight action these days. And again, you're going to see just on Sunday night into Monday, much weaker tape that was well off those lows after the European. So the market is really moving 24 hours. A lot of this blending together. 31.75 was the close on Wednesday. And that's going to bring a tremendous amount of resistance. And for the NASDAQ, that's right around 10,050, 10,075. That's going to be a tremendous amount of resistance. And the market is working its way back up to there. Overall, intraday, yesterday, despite that weak open Sunday night, you didn't see the S&P really spend time below the 200-day moving average intraday. So you're seeing the market lift up and move off of here. There's still headwinds out there, even though the Fed is going to support the economy. You do have China and India. There has been casualties on the border. That's heating up. You have North Korea sort of moving into South Korea. That situation's heating up. The U.S.-China trade war, it has not disappeared. The EU is talking about measures. China is retaliating against Australia with measures. So the trade war from country to country is still very, very relevant right now. And then on top of that, China closed schools with the reemergence of the virus. You're starting to see virus uptick a little bit here in the U.S. So a lot of uncertainty out there. The road isn't clear, but you did see yesterday a tremendous amount of call buying, and we've talked about it many times before as we head into quadruple witching, especially. The more calls the retail investors are buying. There's nothing wrong with buying calls and betting that the market's going to go higher, but what it does is feed on itself. You're seeing the market rally on those calls because the market makers who are then selling those call options, they have to then buy futures and buy stock to hedge off their risk, and the market melts higher. That's what we're seeing. It's one of the reasons moving the market from yesterday into today, and just some healthy technicals. So let's take a look at the chart here. Everything on the board today was green. You really could have just almost bought anything and ended up positive on the day. Here's the S&P. You can see this is the 200-day moving average. One thing I want to show here is that MACD. You've seen the MACD start to move back closer, kind of round out back above that signal line potentially. Something that we saw here in May, and really what it's done is fuel the rallies, second legs, or reestablish a rally. So looking at that, you got this resistance here. This is Wednesday's close, 31.75 area. So the market has some unfinished business in achieving that. Outside of that, yeah, I mean, the S&P held this breakout area, held the 200 moving average, and this is where we find ourselves. It's been a strong week so far, and there's no reason to think that it's not going to continue going higher, barring any fundamental situations that heat up. Now, the NASDAQ, very similar, MACD rounding out. It's been a pattern where, even though a deeper cut here, it's been a pattern where you get round out, cross back above that signal line, and it fuels the next leg. So the NASDAQ, 10,000, 10,050, 10,075. That's the next big resistance we talked about in the Morning Express. Let's take a look at the intraday here in the S&P, and this is right where the S&P sort of finished today. A lot of volume. This is where Wednesday night came into Thursday, and this is right around 3,100 because this is where we opened into Thursday's session here. Right in there, that's where all that volume is. That's the on that open, yes, on Thursday morning. And then you have up here 3,200, a lot of volume traded. So this is just really a picture, a glimpse over the last week, and we're running into that volume. So a tremendous amount of resistance here. This is becoming a sticky pocket here. So we could see this thing ping pong back and forth. 3,200 potentially being a ceiling here, heading into quadruple witching. 3,100 developing to be a floor maybe as we head into quadruple witching. So this is the 200 period moving average on a 30-minute chart, and that looks to be bringing some decent support. Not only that, you got some support as well that's coming in down here, 3070. So again, you're going to see this sort of build support, potentially 3,100 being a round number, resistance 3,200 being a round number, and we still got 3 days left to go, and that could be your range through the next 3 days, barring any given fundamental news. CPI data coming out of the UK, CPI data coming out of the Eurozone tomorrow, building permits. You also have the Bank of Canada, CPI coming out of Canada. So just a number of things to look at. Crude oil inventories too. So there's going to be some volatility. Speaking of crude oil, let's take a look. You have options on the July contract expiring tomorrow, going to bring some volatility. Here's the August contract, bringing a little bit of a floor at previous highs. That's about 35.5. The 382 retracement is going to be the next floor. It's going to be a good support area, 3250. That's where we would really want to be a buyer of crude oil if we did like the landscape, if it got there. In the same sort of MACD position here. You get the MACD rounding down, and it could be crossover that can help fuel the next leg. So keep an eye on that. As the market has moved back this week, we've seen yields, Treasury yields rise again, Treasury prices come back. So one thing to really keep in mind here is the 10-year Treasury. It's not back at those 90 basis point levels we saw about a week and a half ago. Where we are, though, is it's about 75 basis points. And it's an interesting scenario because I'm going to show you here in the chart with the 50-day moving average on the 30-year, the 10-year, and the 5-year. And it's constructive for really showing a steepening curve. And that's supportive to risk, supportive to the economy, and it supports the fact that we're starting to see a bounce back in activity, something that could continue here at least a little bit over the next couple months as it's stagnant to better, and then really picks up here again into quarter 3 and into quarter 4. That's supporting that narrative. So if you look here at the 30-year bond, this is really what won the trade if you're looking for the volatility. And I thought it was important to show where there could be a good floor that's developing above last year's high. And this is also a level here as it pulled back in late March. Really big floor, 167. That's where we'd want to be a buyer in the 30-year. But overall, this is the 50-day moving average, decisively below it. When we really started to trade through here, trade and breakdown, it's come back, but it stayed decisively below the 50-day moving average there. That's going to be resistance. For now, it's showing that the momentum is turning south. So that does favor a risk-on environment. Keep that in mind. Now for the 10-year, they were trading right at the 50-day. I wanted to show you, looking all the way back here on the 10-year, going back to August of, this is 2012. This is a high here in the 10-year. This is a continuous chart. 135. You got about 134 here. So there's big support levels below if this thing starts rolling over. So, we have been very bullish on Treasury prices for a very long time. We're less bullish now. One of the main reasons being less bullish is after the Fed unleashes tremendous amounts of liquidity, QE1, QE2, QE3, it's put a top in prices and a bottom in yields, and we're starting to see that develop here. So keep that in mind. So we would like to be buyers at much lower levels in the 10-year and the 30-year, but it doesn't mean that you can't catch the downside, and we've already done that once with the Blue Line trade alerts. We had a profitable 10-year trade, so give us a call about that if you want to discuss that anymore. Now, looking into the 5-year, a little bit of a different scenario here. So if you look at the 5-year here, this is really staying above the 50-day moving average. Today was the first day that it flirted with that again after coming back above it. So interesting to see how this 5-year plays out. For now, it broke down below it, but then obviously recovered it upon some of that weakness through last week and ahead of the Fed. So, as the 5-year kind of trades here, is where does that could be a little bit of a signal. Does it sort of gravitate higher? Is there some risk off, or upon risk on, does it move lower? And is that what really kind of fuels the 10-year and the 30-year much lower? So keep a close eye on those. But regardless of what the rates do, we don't think the rates really go lower for too long. But we like gold, and we like the fact that there's all this liquidity out there, and if the narrative of some better data starts to pick up, you're going to see inflation hold, to inflation to be a little better. That's supportive to gold, and gold's been very technically constructive at the $1,700 area. It's down to $1,680. So you had this, again, I've talked about it many times, inverse head and shoulders that has now been as a breakout there. It's now acted as support. Big strong recovery last week. Yeah, yesterday dipped down to 1705, left a big tail. But if you discount that tail, it's just interesting to look at a bull flag pattern here. And the reason why we like the bull flag pattern here, not because it's a true bull flag, because yeah, we're cutting that tail off, but more so because it's just the positioning type. You have a lot of resistance up there at 1740, and the same sort of positioning theory behind a bull flag. Slightly lower lows, slightly lower highs, picks up when the market can stay above there. So we have strong major 3-star resistance at 1740, 1743. If we stay above there, which we're not able to do today, if it gets above there, it can stay above there, it's going to force a positioning move higher. So that's one thing we like about gold here. And then silver. Really nice how it held the 200 moving average yesterday, and that sharp pullback to $17. Bounced back pretty good. It still has its work cut out for it, because it has not extended, out above those February highs prior, as gold did. And overall, it's just it can't find a reason if it's going to be with the risk on crew or if it's going to be on the deflationary risk off crew. And gold has the same sort of problem, but gold has already extended its range higher. Silver hasn't. But the interesting thing here for silver is you do have the 50-day moving average catching up to the 200-day moving average, and that's go time. If that 50-day gets above $17, silver better be making a move higher. If it doesn't, and it closes back below the 50-day moving average, that is a sign for us to stay away from silver. For now, we want to believe that the 50-day moving average is going to cross out above that 200, going to get the golden cross, and it's going to fuel silver out above $19, which is then going to fuel gold out above $1,800. So that could be coming. And then euro, really interesting here. This is a weekly chart on the euro. Again, you probably see most of my charts are all dailies. This is a weekly chart. You can see here, it does give a perspective of, even though the euro's rallied very strongly in the recent weeks, it really hasn't done anything too special. This is the 200 week moving average. Got some tails up here. It can't hold those overall gains, and there is some signs of starting exhaustion here in the MACD, but it's not there yet. But the daily, a little different story on the MACD, starting to potentially come back across its signal line. Tomorrow seems it's going to be pretty critical. Through the rest of this week, it's going to be pretty critical for the currency situation. Does that euro start to come in a bit? Does it go back down to about 110.5? Now the dollar, interesting. When I talked about the bull flag earlier with gold, it's more about a positioning thing. Here's the dollar index, came off that low, and now it's slightly lower lows, slightly lower highs. That is what can fuel the dollar higher. Good, decent close today, holding some ground, although it was not on the highs of the session. We like to think we're going to see a move here in the dollar index back up to 99. Need to see a little bit of a catalyst. risk off in the market. The stocks in overall broadly has supported the dollar. So, if the stock market does rally into quadruple witching, then it may hold the dollar back from following through and forming that pattern. So again, interesting week ahead. Some data tomorrow, and through the rest of the week, we are here. We are here to help. Do not hesitate to give us a call. A lot of things out there we like. Our Trade Alerts program has a number of trades on right now. It actually has a slightly bearish position in gold, and it's very interesting, very well played out. Give us a call. We'd love to tell you about it. 312-278-0500. We're here to help. But remember, futures trading involves substantial risk of loss and is not suitable for all investors.